financial advisors, planning for life. Wealthway Financial Advisors, planning for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines. Give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m., and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979, whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies. That's what we're going to talk about here tonight. Retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance we are here to discuss tonight. Okay. Tax season is upon us. How exciting, right? Taxes, though, they don't just happen on April 15th. So we're going to talk all things tax tonight, since this is the season. But many people think about taxes only once per year, right around this time, right, when you have to start preparing your tax returns. But most tax outcomes are really determined months earlier, even years earlier in some cases, by decisions made throughout the year or in previous years. Tax planning is year-round. It is not done on April 14th. It is not done on December 30th. It's really done throughout the year if you want to do tax planning appropriately and lower your tax bill where it is prudent. So, choices related to income, investments, retirement contributions, distributions, and charitable giving all influence how much someone ultimately pays in taxes. So tonight, in tonight's show, we're going to focus on the financial decisions that people make during the year that can shape your tax outcome long before April 15th arrives. So by helping you understand which decisions have the biggest impact, we're going to encourage proactive planning rather than reactive tax filing. Really, by about this time of the year, most tax planning is already in the books for 2025, and there isn't much, save for a few notable exceptions, that one can do at this point other than fill out your tax forms, get them filed, and hope for the biggest refund possible. All right, so when it comes to tax planning, the goal is not to eliminate taxes entirely, okay? Although that sounds nice in theory, of course. Usually, I usually respond to people say they don't want to pay taxes. How can we help them not pay any taxes? Well, you do things you can do. You can lose a bunch of money, or you can give away a bunch of money. Those two things will, without a doubt, lower your tax bill, and maybe even to the point where it eliminates your tax bill in any one particular year. So, yeah, losing a bunch of money or giving away a bunch of money. But what that won't do is it won't grow your net worth, at least not consistently if you try to do that every year. Taxes are a normal part of your financial life. And the goal is to make informed decisions throughout the year so tax outcomes are reasonably predictable, that they're aligned with long-term financial goals, and then minimized where prudent. So we have a saying at Wealthway that we don't let the tax tail wag the financial dog. And I'll probably say that about 5 times before the show is over tonight. What generally is the goal of our clients is steadily growing their net worth over time, so that they use that money to grow their net worth over time, to enhance their financial options as life evolves. And so growing your net worth is going to generate some taxes, at least according to the current tax code that we have in the United States. So, yes, we want to be mindful of taxes. They're most families, most households' largest expense. Not surprisingly, when you factor in federal, state, property, sales taxes, that we pay. You add up all the taxes, it's a big number. I know I'm preaching to the choir here on WNIS. But for many Americans, tax season feels like a moment when taxes are determined. When you're filing, that's when you're going to figure out your taxes. But in reality, most tax outcomes were shaped throughout the previous year by the financial decisions that you made or didn't make throughout the course of the year. So here's a few IRS fun facts, if there is such a thing. The IRS processed more than 200, and this from tax year 2024, most recent we have data. The IRS processed more than 266 million tax returns in 2024 and collected over $5.1 trillion in federal tax in the calendar year of 2024. Seems like $5 trillion would be enough to run the federal government and maybe have a little bit left over, but I think, as everyone knows, that's not the case. The federal government here in recent history has been spending more than it takes in each year, and at some point that will be dealt with. Also, IRS filing data shows that a majority of taxpayers receive refunds each year, which people often confuse the idea of a refund with sort of with lowering their tax burden or getting a tax deduction. No, a refund after you file your taxes just meant that you overpaid your taxes for the previous year, and due to that, you're getting money back. And while that might feel good, it really means that throughout the course of the year, you had more withholding or you paid more in taxes than you needed to throughout the course of the year. Generally speaking, we like our clients to sort of break even when it comes to doing their taxes. They don't pay a big tax bill at the end of the year. They don't get a big tax refund at the end of the year either. That way you have full use and enjoyment of your funds throughout the course of the year instead of loaning them interest-free to Uncle Sam and then getting that refund back at tax filing time. So getting a refund is more about reflecting withholding, the amount you have withheld, than true tax savings. So filing taxes, what we're all doing around this time of year, and probably a bunch of people going on extension and pushing that out to October, but tax filing this type of year is largely reactive. We're in most actions we can take for 2025 are already in the books, and the tax filing is just the reporting of that. And April is usually too late to change most outcomes. IRA contributions are a notable exception. So you can make, if you are eligible, deductible IRA contributions, Roth IRA contributions, or even non-deductible IRA contributions up until your tax filing deadline of April 15th that are impacted on your 2025 tax returns. But for most people, what's done is done. And planning decisions earlier in the year matter than later in the year because usually the effects of those decisions have a compounding effect. So the sooner in a calendar year you can make advantageous tax decisions, typically the better the outcome when it comes to filing time. And these financial decisions accumulate over time. So each year that you manage your tax affairs or your income affairs to try to lower that tax bill as low as legally reasonable, each year that you do that, they have a compounding effect. And so ultimately, the goal, or at least what we try to do with our clients, is reduce their lifetime tax bill. Not just the tax bill in any given 1 year, but sometimes decisions, strategies, recommendations that we implement in one tax year can pay dividends over a client's lifetime. A Roth conversion strategy is one of those that have the biggest effects if conditions are right in your financial life to do a Roth conversion. And for, I would say, most people, they aren't. The numbers and the math don't work. But still, for a good chunk of the American population, especially those who retire relatively early, in their late 50s or early 60s, those tend to, other conditions being right, have the best opportunity for Roth conversion strategies, and implemented at a aggressive level, $100,000, $200,000, $300,000, $400,000 per year, maybe for several years. Yes, you will pay tax up front in the year of conversion on the amount that you convert, but then you have a lifetime of tax-free income from which to draw from Roth IRAs, nor do you have to take required minimum distributions from Roth IRAs at age 73, which most people coming up here will. So tax planning year-round and trying to lower that overall lifetime tax bill, it's where we can sometimes save our clients literally tens of thousands, hundreds of thousands, sometimes, in some cases, millions of dollars of we can grow our clients' net worth by tens of thousands, hundreds of thousands, or millions of dollars of additional net worth by tax-saving strategies if implemented carefully, thoughtfully, and over time. All right, going to pause right here for our first break. Going to be right back after these messages. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight we're talking about taxes. Taxes, year-round pursuit, not just done on April 15th. And one of the largest tax savings actions that we can take are pretty much available to most all of us, and that is retirement saving decisions. One of the most common ways people influence their tax outcome is by deciding whether or not and how much to contribute to their company retirement plan. So contributions to certain retirement accounts can reduce taxable income in the current year, while also, of course, building long-term financial security. So one of the things we harp on in this show, one of the first place people should look to start building long-term sustainable wealth is their own company retirement plan. And sadly, a large percentage of the population does not take advantage of the plan or doesn't take full advantage of the plan. A little bit of facts about company retirement plans. Americans hold about $37 trillion in retirement assets across workplace retirement plans and IRAs, and still, you do the math, that's not enough. IRS retirement contribution rules provide tax advantages when contributions are made to qualified retirement accounts during the tax year. So, yes, most of us have the ability to contribute through our employer via withholding on our paychecks into a retirement plan. Those are the 401ks, the 403bs, the TSPs, simple IRAs, 457 plans. They all come with different numbers and different acronyms, but they all kind of do a similar function, and that is incent workers to contribute to their own retirement plan in order to supplement the Social Security income that they're going to get. So when you do that, most plans contribute you when you do that through your payroll, you contribute what's called pre-tax, or before this money is taxed, it's redirected into your company retirement plan. So you do not have to pay tax on that money that you put into your retirement plan. And therefore, you get a de facto tax break today for the money that you contribute. The more you contribute to your company retirement plan, the more you lower your taxable income and the less tax you pay. One notable exception to that is if your plan allows for Roth contributions to the plan, which we love in many sort of circumstances, and there could be a variety of reasons to contribute to the Roth portion of your retirement plan. You would not get a tax break to the contributions that you contribute to the Roth, but once in the Roth, that money will grow tax-free for the rest of your life. So, but most plans don't have that option yet, and most people aren't aware of it or don't take advantage of it, and they contribute pre-tax, which, generally speaking, early in your career, when you're just starting out and income is relatively low, contributing to the Roth portion of your retirement plan is probably to your benefit. As you get older, as your career evolves, hopefully as you get promotions, you get raises, as you enter higher income tax brackets, then pre-tax contributions, when you do the math, tends to be most beneficial. Generally speaking, you want to get your tax break when your income is highest, when you're in the highest tax bracket. So contributing to your company retirement plan is one of the easiest, fastest, best ways to give yourself a tax break throughout the calendar year. And the waiting until the end of the year or waiting until you feel like you have enough money to contribute will just continue to sort of delay this decision. Like I always recommend, just get the habits that you build in your financial life far more determine whether you become financially secure later in life or not than the actual investments that you make or the accounts that you contribute to. It's the habit. So just starting the habit of contributing to your company retirement plan is the best thing you can do to lower your tax bill and set yourself up for success later in life. And consistent saving habits influence taxes and long-term wealth. It's that consistency year after year of continued savings. And don't forget, almost all company retirement plans offer some sort of employer matching contribution to incent you to contribute to your own retirement. That means that when a lot of times you'll see that companies will match your contributions of 50% up to 6% of your pay. So if you contribute 6% of your gross salary, then your company will typically match up to 3% of that. And that means a total of 9% of your gross income is being set aside for your future retirement. That's a good starting point for most people, but you got to contribute that bare minimum 6% in order to get the maximum from your company. So tax advantage retirement accounts kind of act like a shield that temporarily protects income from taxation while allowing your savings to grow tax deferred in those company sponsored retirement plans. So make sure you're taking advantage of those. All right, going to pause right here for the news. Going to be back in just a couple minutes. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next show will actually be in 3 weeks instead of the normal 2, just due to the way the calendar falls. Next show will be in 3 weeks on Tuesday, April 14th. But if you can't catch us live every second and fourth Tuesday of the month at 6 p.m., get the show as a podcast. Search for Dollars and Common Sense wherever you get your podcasts. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button, and once every week or two, we put up an interesting and informative financial planning post to keep you engaged in the process. All right, tonight we're talking about taxes, tax planning, and how to minimize your tax burden, something that we all like to do. All right, let's talk about how taxes, or rather investment decisions, impact taxes. So investment activity during the year can have a significant influence on the taxes you pay in that calendar year. Buying and selling investments can create capital gains or losses that directly will impact your tax return. And I will say that increased participation in financial markets has expanded the number of households affected by capital gains taxes. And that's a good thing, because the more people who participate in the financial markets, generally speaking, if you do it the right way, the better off you will be made financially. However, that will come at somewhat of a cost in terms of capital gains taxes. Now, capital gains taxes do not apply in certain types of accounts, namely your company retirement accounts. All of the trading activity in there, non-issue, no taxes. IRAs, inside an IRA wrapper, buying and selling, no taxable income implications until the money comes out of those accounts. So what happens in those types of accounts, tax-free, tax agnostic, non-issue. Where taxes do come into play from an investment standpoint, though, is what we would say a regular brokerage account or investing directly with a mutual fund company like, say, Vanguard or Fidelity, outside of a tax-protected wrapper, direct investment with the company. The trading activity then will generate taxable implications. Hopefully, in most cases, it's a gain, right? But you could also sell things for a loss, and when you do, that loss is can be used to offset gains you have in a tax year. So, one of the biggest mistakes, one of the most frustrating aspects of the biggest mistakes we see when clients come to us, and one of the most frustrating aspects of investing for do-it-yourselfers is the idea of tracking cost basis. And if you have no idea what I'm talking about when I say the term cost basis, then you should probably do some research and or work with a professional to help you do investing, because cost basis is a very important element in determining how much tax you ultimately pay, investment taxes you pay on your investments. And what cost basis is, just like it sounds, it's the cost, what you bought an investment at. On a particular day, you invested $100 in XYZ mutual fund and bought 17 shares of that fund, okay? All that information is important to preserve and keep and memorialize somewhere. Nowadays, a lot of it's electronic, and the custodians or the mutual fund companies have gotten much better at tracking that information. But if not, preserving electronically or in paper statements or in PDF statements. But anyway, somewhere you need to retain your cost basis information, because when you go to sell that investment, whether you have a profit or not is determined by the cost basis. So when you sell the investment for more than what it costs you, then you have a gain. That's called a capital gain. And that gain then gets realized when you sell that investment. And in that tax year that you realize that gain, it is subject to investment taxes. Now, investment taxes or capital gains taxes are taxed at a lower, more favorable rate than your income is that you get from your employer. So there's somewhat of an additional incentive then to invest even outside of traditional retirement accounts. And so, for example, and I won't get into all the details, but depending on your ultimate tax bracket when you go to file, your capital gains rate in other words, the tax that you would pay on your profit could be as low as 0, depending on, again, your income, or 15%. That's what most people pay. So you have a profit of $100 on the sale of investment. Well, 15 of those dollars are going to Uncle Sam, and you get to keep 85. Or some of you high income earners, you pay 20% on your capital gains profit when you go to sell your investments. But in order to even do the calculation, you have to retain that cost basis. And so custodians, the companies where you do your investing, whether like Schwab or Fidelity, it used to be TD Ameritrade, but they got bought by Schwab. Could be Pershing. Could be directly with a mutual fund company or ETF company like BlackRock or T. Rowe Price. A lot of them have become better at tracking your cost basis and preserving that. And so each year they'll send you a tax form 1099, and that should kind of do the math for you. And you have your profit for the year or losses, and you transfer that information into your tax forms, and that would contribute to your taxable situation in the tax year that you make sales. But you've got to retain that information, and it is fairly common that we still see today people who have long held investments or maybe inherited investments a long time ago. Usually this happens more with individual stocks than it does ETFs or mutual funds, but they have missing cost basis. And when you have no idea what the cost basis is, how much you paid for an investment and the dates in which you purchase X numbers of shares, if it is missing, then you got a problem. And when you ultimately go to sell that investment, and then it's the responsibility of you, Mr. and Mrs. Taxpayer, to track that cost basis and accurately report how much profit that you have from that investment. And without the cost basis, then guess what? If the cost basis is zero, then every dollar of proceeds you get from that sale is deemed to be profit, which subjects a lot more of that transaction to capital gains tax than it otherwise should if you had accurately tracked that cost basis. So the concept of cost basis when it comes to investing and investment management, investing taxes is very important, retaining and tracking your cost basis. Now, there's also short-term versus long-term capital gains. Short-term capital gains are profits that you have on investments that you held for less than a year. Long-term capital gains for investments you held more than a year. If you sell an investment at a profit that you held for less than a year, then that profit will be taxed at higher ordinary income tax rates than the preferred long-term capital gains rate. So incenting, essentially, tax code incenting people essentially to hold investments for at least a year to get a preferential lower tax rate. So something to be mindful of there. Short-term versus long-term capital gains has an impact on what tax rate your profit is taxed at. And while you should always be mindful of taxes when it comes to your investments and selling those investments, again, don't let the tax tail wag the dog. If it's time to move on from a particular investment because it's not performing as it should compared to its peers, then regardless of the profit embedded in that investment, it's probably a good idea to sell, incur that capital gains tax, reset the tax basis, and get yourself into a better, hopefully better, performing investment long term. And that's how you effectively grow your net worth faster over time. All right, I can pause right here for the last break. 627-7979. I'm certified financial planner Kevin Zibna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zibna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, check us out online at wealthwayadvisors.com. All right, tonight we're talking taxes. and how to lower your overall tax bill. Well, it's a little late to be doing too much for tax year 2025. We're right on time for tax year 2026. So if some of these ideas resonate with you, now is the time to take action, to take advantage of tax savings opportunities now to try to lower your 2026 tax bill when you complete those forms next year. Okay, income timing and tax brackets. The timing of income can influence the tax bracket that someone falls into for the year, right? So you got income from bonuses, business activity, which can be a little irregular, and other sources that shift taxable income between brackets. And no surprise, the U.S. tax system uses a progressive tax regime or tax scheme. So that means, by definition, by design, the more you make, the more they take. This some sort of mythical idea that is taken hold in some areas of our populace that the rich don't pay much in taxes is false. It's objectively false. It's blatant lies and misinformation. It is possible that people, high income earners, can in a given year or two pay low or even no tax, but that means, like I said at the start of the show, typically that means they lost a lot of money in that given tax year, which means they had a lower tax bill. But in most years, they make a lot of money, they continue to make a lot of money, and they pay a lot in taxes. They pay the most in taxes of any segment of our population. So the more the tax code by design, you can't get away from it, you can't get around it. The more income you make, the higher percentage of that income the governments take in order to fund their operations. So many taxpayers misunderstand the idea of these marginal tax brackets, and they assume that all income is taxed at the highest rate. So without trying to get not too deep into the numbers, but I got to throw some out here. So generally speaking, our brackets, our tax brackets where your income falls, and this is your taxable income, and that's the income after all the deductions that you do on your tax returns. Those brackets range from a low of 10% to a high of 37%, at least federally here. We're just talking about federal tax rates. In Virginia, most people pay 5.75%. But at federal tax rates, a low of 10 to a high of 37% of income. But what that is, it's sort of a graduated stair step. So to put some numbers on it, married filing joint, up to about $25,000, that income is taxed at 10%. From $25,000 roughly to $100,000, that's taxed. That income is taxed at 12%. And then from $100,000 to $210,000, that's 22%. $210,000 to $400,000, that's 24%, and so on up the ladder. So the income in each segment is taxed at those rates. It's not just whatever highest rate you end up at, all of your income is not taxed at that highest rate. Everyone gets to, I guess, enjoy the lower tax brackets as their income moves them up the tax rate ladder. And for people who are single filers, those numbers are roughly cut in half for where those tax rates fall. But you take the highest tax rate at highest federal tax rate at 37%, and then you take your state income tax, which here in Virginia is around 6%. So that's about 43% of that upper income. And then there's a myriad of complex and complicated reductions in deductions you can claim, an elimination of exemptions. There's excise taxes that the tax code layers in, so that are sort of hidden from all those numbers. And believe me, people who make probably taxable income upwards of $600,000 to $700,000 that are seeing almost half that income above that number being eaten away by taxes. That's how progressive that our current tax code is. So you need to know kind of the difference between marginal and effective tax rates. The effective is kind of the average of those. Takes your tax, the total tax dollar amount you paid divided by your taxable income. That's your effective rate. That's the average of all those brackets. It's a good number to know, but ultimately it's the marginal tax rates that determine how much you pay. And then you got to be aware of income timing on how that impacts your tax outcomes. If you can shift income from one tax year to another, you may be able to smooth out the tax bills that you owe so that you don't run up the tax ladder too high and subject too much of it to those higher 35 and 37% rates. And sometimes business owners have the ability to structure when they receive income, depending on their line of work, the industry they're in, that type of thing. And they have a decent amount of control on when they realize income and then when it gets subject to taxation. So generally speaking, the more you can defer income to another year, the better off you are from a tax perspective. And then the last item I want to talk about when it comes to tax is charitable giving and tax strategy. So charitable giving, it's another financial decision that can influence taxes when planned thoughtfully. So qualified charitable donations, donor-advised funds, donating appreciated stock rather than selling and donating, all are tax-saving measures. Remember what I said at the beginning of the show? You want to lower your tax bill? Quickest, easy way to do that, lose a bunch of money or give away a bunch of money. And you'll find that those activities are deductible to your income and will go a long way to lowering your tax bill. But of course, in the grand scheme of things, while that might be good in the short term, what we want to do in the long term is grow our net worth over time. So Americans donated approximately $557 billion to charitable organizations in 2023. And IRS rules allow eligible taxpayers to deduct qualified charitable contributions if you itemize. Unfortunately, or maybe fortunately, with the higher standard deductions that we have at our disposal now, only about 10% of people can actually itemize their deductions. All right, that's all the time I have for tonight. I will be back in 3 weeks on April 14th to talk a little bit more about tax planning. But until then, I'm Certified Financial Planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.